Welcome to our next virtual summit. My name is Nicoletta Polano. I'm a senior compliance professional at Zurich Group, and I'm based in Zurich, Switzerland. I'm the next external connection lead and the organizer of this summit. Today, I will be the moderator of this event, the second event of our next summit dedicated to the future of economy. The session will be organized as follows. Each speaker will give a keynote, and then we will open the floor for the discussion. To post your questions or comments, please enter them in the Q&A chat. I will pick them up and pass them to the speakers. I will then wrap up the session and seize the opportunity to present you contents and speakers of the other summit events planned for the rest of the week. Now, let me introduce you to the speakers of this session. Guy Miller, Chief Market Strategist and Head of Macroeconomics at Zurich Insurance Company, regular guest on financial television and radio channels, and representative of Zurich as a member of the World Economic Forum Financial Future Councils and the Market Monitoring Group of the IIF. Ambassador and active proponent for responsible investment and the development of the green bond market. Previously a US equity portfolio manager. Theodor Cojoianu, academic, social entrepreneur, and sustainable finance professional. Assistant professor in finance at Queen's University Belfast. Researcher in the field of responsible investment and PhD in Geography and Environment, Responsible Investment and Innovation. Recently appointed member of the Platform on Sustainable Finance at the European Commission. Matteo Ward, entrepreneur, activist, TEDx and Keynote speaker. Co-founder and CEO of WRAD, a fashion startup focused on sustainable innovation, education, and design. UN CFACT expert and advisor for contributing to shape framework policies for more traceable supply chains in the fashion industry. Vice President, Fashion Revolution Italy. Former senior manager and co-chair Diversity and Inclusion Council at Abercrombie & Fitch. Guy, the stage is yours for your keynote.
Thank you very much, Nicoletta, and good morning, everybody. I think I'll spend the next 5 minutes really just setting the scene in terms of where we stand today in terms of the global economy and also what that could mean going forward for a more sustainable recovery. But to kick it off, I mean, we're often focused on the impact of COVID. But one thing I just wanted to highlight was they were already in a very challenged position as we started this year. If you think back, global growth was already slowing. Interest rates in many parts of the world were in negative territory, here in Switzerland in particular. Inflation was very low and it was missing the central bank targets by quite a wide margin. We also had global debt levels in terms of corporate debt at record levels and in terms of government debt, in many cases, also at record levels. And if that was not enough, we had a global trade war, at least between the United States and China, with other countries getting pulled in as well. And we also, of course, had to deal with the fourth industrial revolution, digitization, and the disruptions that was likely to cause, as well, of course, as climate change and the disruptions that that itself brought. So my point is that there was already an inherent vulnerability to the global economy. And the last thing, of course, that was required was an exogenous shock. And indeed, that's exactly what we got at the start of this year with COVID-19. And I guess what that did was the global pandemic, it really highlighted the vulnerabilities of societies. I mean, this shouldn't have been a great surprise. Many people had predicted that something like this could happen, but it showed a degree of complacency and lack of investment over the previous decades in the health system that really made us vulnerable, and it was very hard to quickly adapt to contain this. So what did governments do? Well, they did really almost the only thing they could do. And this was very unusual. They engineered a recession. They effectively switched the light off. They closed down their own economies in a bid to try and contain the virus. And they did this kind of collectively. And we saw this spreading across the globe from east to west. And what did this mean? Well, if you think about this, that in February in the United States, an example, we had unemployment at a 60-year low of 3.5%. And within 2 months, we went from 3.5% unemployment in the US to about 15% unemployment. Again, this word unprecedented spike we saw as people were made redundant, and about a quarter of the US workforce was affected in some way in terms of having their hours work or their job interrupted. And of course, what this meant was that we actually endured some of the worst conditions since the Great Depression of the 1920s and 1930s, the worst economic environment for over 100 years. Now, that's kind of a doom and gloom picture that we have painted here, but actually what occurred was also quite an unprecedented development, which is that the central banks and the governments, they opened up the spigots to try and put a floor in this. In terms of the central banks, in a bid to protect what had been a man-made or a pandemic health crisis developing into an economic crisis, the last thing they wanted was, of course, a financial crisis on top of all of that. What they did was they injected liquidity. The central bank balance sheets were buying up assets. They were providing support mechanisms to allow these financial markets to stabilize. And indeed, what we saw at the start of this year was that most equity markets only fell by about 35%. Now that sounds a lot, it is a lot, but when you compare that to the 50+% of the financial crisis in 2009 and the 50+% that we saw the bursting of the dot-com bubble in 2000, it was relatively well contained. And indeed, the recovery that we've seen, about a 50% rally since then, implies that the actions that they took had the desired effect, at least for now. We prevented a financial crisis developing. But maybe more profound has been the fiscal initiative. In other words, what the government have done to try and keep the productive fabric of the economy alive. So we saw paychecks being mailed out. We saw small businesses being supported. And to put this in sort of a monetary terms, or trying to get a picture of that, we've seen about 12%, if you think about the size of the global economy, about 12% of that global economy has been provided in terms of support mechanisms to keep small businesses functioning and to keep workers getting a paycheck coming in. Now, in a way, when you think about all I've said there, that has been a huge shift that we've seen in terms of the way that governments and central banks and societies operate. And of course, we're still at the mercy of a virus that is very hard to predict what happens next, and the outcome will ultimately be determined on what the next course of event is for the virus itself. But I wanted us just to kind of take stock of where we are there, because that is all very dramatic, and it is dramatic. But what has this meant? Well, if you think back to earlier on this year, April, May, June time, you know, how many contrails did you see in the sky? Very few. Aircraft were not flying, they were grounded, they were parked. Motorways were quiet. We saw pictures on the internet of the clear skies in many parts of the world that were previously smog-ridden. In other words, we saw emissions fall quite dramatically, about 17% at the trough. But if you look at the estimates for this year, it's likely that CO2, for example, will fall by about 8% over the course of 2020 versus the previous year. Now that seems quite a lot, and indeed this is the most it's ever fallen in the last 120 years of data. But to put that in context, that really only takes us back to the levels of emissions that we were at in 2010. And what is perhaps a little more concerning is if you think about the huge disruptions that society has faced over the last 9 or 10 months, to get that 8% decline in CO2 emissions, in order to really fundamentally manage to get to kind of a 1.5 degree world, which was the idea through the Paris Agreement and what we're all striving for, we need that kind of 8% decline, not in 1 year, but we need it in every single year until 2050. So just think about what that means, how disruptive that could be if indeed it was to occur in the way that it's occurred over the last 7 or 8 months. Now, while that's a good thing, the bad, or the flip side of this economic slowdown, is also really quite profound as well. Societies need economic growth. They need to be able to improve. We need a health service to develop. We need education to improve across the world. And actually, if you look at what the World Bank has forecast for 2020, this is likely to be the first year since 1998 that global poverty will actually rise. And indeed, they predict by the end of this year that 70 million people are expected to have fallen into extreme poverty. So there's a downside about this shrinkage that we've seen that should not be underestimated as well. So one thing I wanted to leave you with before we open up to the other keynotes and debate is that we need to think about how do we manage to balance economic growth, which is a good thing, with reducing pollution, which is clearly a bad thing. And if we think about what happened after the financial crisis in 2009, what we saw was the governments, the central banks, we applied the usual tools to get the economy to grow again. In times of panic, that's understandable. But what they didn't think about was how do they make a recovery more sustainable, greener, and more equitable in the long run. Now we've got a great opportunity here. Now we're in a position where we need to think about how do we make this recovery a better recovery, a fairer recovery for everybody. And that's something that hopefully our coming discussion will delve into in a little bit more detail. I'll leave it there, Nicoletta, for now.
Thank you very much, Guy, for your keynote. Now I leave the floor to Theodor for his.
Thank you so much, and hopefully you can all hear me well. So, Nicoletta, I'm really grateful for the invitation to speak. And what I want to do in the next few minutes is just share a few of my thoughts on how I think finance can help overcome many of the societal challenges we are currently really experiencing, and how really the investment decisions that we make today will impact the next generations. I'm glad to see that the theme of your summit is next, and you are looking ahead. Not just for ourselves, but for our children and our children's children and so on. And so while Guy was mentioning, thinking back and perhaps January or even last year, I think for many of us, it's probably a hard exercise to do. And we probably need to sit a second and be like, oh yeah, what was life like last year? And it seems also foggy. And I tried to do this exercise and trying to reflect on what was it like, what was the next generation asking of us last year. And the one thing that really came back to my mind were the children protesting in the streets, led by Greta Thunberg and other very passionate teens all around the world, coming and asking of us to deal with the climate challenge. And that was all before our attention was dragged to the current COVID pandemic, and it's rightly so. We should be dealing with the current pandemic in the best way we can, but in the same time, we shouldn't lose track of the other challenges that we know are waiting for us, and we hopefully have the opportunity, again, as Guy mentioned, to build back better from this pandemic and look ahead on how to deal with other great challenges. So what I'd like to do is to perhaps say how finance can solve climate change, and it's applicable to other problems and other issues that we are facing. And start a bit from the climate science and tell you why we need to do this and what's really our benchmark, and then talk a bit about the how. So the science is clear. We have the IPCC, the UN emissions gap report, the EU technical expert group on climate change, which have told us that in order to avoid the most dangerous consequences of climate change, we need to reach a net zero economy. And this term net zero sounds a bit fuzzy, but if you want to think in a bit of a bathtub analogy, you have a bathtub, and if you want to stabilize your warming, you also need to stabilize the level of emissions that you put in your bathtub. So in order to do that, you really have to stop your tap if you want your level to stabilize in the bathtub, even if you still have little droplets coming down, your level will still keep going up. So basically, you need to either stop that tap or really turn the drain on so that your level of emissions that come in your atmosphere are equal to those that go out of the atmosphere. If you want a bit of a different analogy, as I am trying, or maybe some of you are also trying in COVID times, as you're staying at home to deal with your diet, is a bit like the calories in, calories out principle. So we all need to be able to monitor very closely emissions going in and also make sure we do take some out. And so what does finance have to do with all of this? Besides the interesting bit here is that over the past decade, we have investors from all of the world with more than 100 trillion of assets under management, realizing that climate is indeed a risk, and that, as perhaps some of your talented actuaries within Zurich would tell you, well, actually, the climate risk is not necessarily something we could look in our past data sets. It's something that is very dynamic, and there's high uncertainty related to it. So we don't know at least the scale. We are aware of the scale and perhaps some of the scenarios we would experience, but we don't yet have the best perhaps models to deal with it. But we do have, though, a hint of the opportunity on how finance could deal with the opportunity, in that we have many of the climate solutions that we could fund and could be indeed tackling this problem head on. But then if we say that the finance sector has really woken up to this challenge, we have investors over the world looking to pour their funds into low carbon technologies. Why has the level of CO2 grown year on year? Of course, with the exception of this year. But if we really think that we're going to go back to the same growth level and to business as usual, then what happened this year, this blip in emissions, will just get back to where we were just last year. So why is this? And I would like to leave you with two reasons and two action points that I think we all need to think very hard. The first one is, it's not just funding climate solutions for economic growth, but it's also about defunding fossil fuels. And there's no doubt about this. Currently, worldwide, fossil fuels investment asset classes are much larger than renewable ones. So we are talking every year up to 1 trillion of new finance going into the oil and gas industry alone across different asset classes. So we really need to get a handle on how we phase down this new investment. And the other bit is the issue of greenwashing. There is no point of companies or governments or anyone claiming that they are being absolutely sustainable when truly the world is on fire. We need to be able to prove and have scientific backed methods in which we show that we are reducing our emissions year on year, and for that we need absolute transparency. So for that, I'm very grateful for your time, and I look forward to the discussion with Guy, Matteo, and Nicoletta. Thank you so much.
Thank you very much, Theodor, for your keynote. And now I leave the floor to Matteo for his, and after that we will open the discussion.
Matteo, we're not hearing you, sir. You're on mute.
There you go. Hi again. Thank you. Sorry, I was on mute. Good morning again. Thank you, Nicoletta. Thank you, Theodor. Thank you, Guy. I think your last point, Theodor, about the need for transparency and the threat of greenwashing is it's actually where I want to start off, because we in the fashion industry are actually facing this threat on a daily basis as a serious obstacle to the rise of more sustainable business models. And let me explain why. And starting off from the title of this panel, Future of the Economy, I think the fashion industry and the economy around fashion today has definitely outgrown the need. We have transitioned in the past I would say 70 years, from a supply-driven economy, which was we were getting dressed because we needed to cover and protect ourselves from the cold, or we needed to have some, some more relief in summer and very hot latitudes, to an extreme demand-driven economy where we're trying to supply more and more clothes every single season, every single week, at a huge cost for the planet, for society, which is absolutely not included in the cost and the balance sheets of fashion, major fashion companies. To understand the problem of the non-sustainability of the economy of the fashion industry, let's try and imagine the fashion industry as a whole, no distinction between fast fashion and luxury, as a circle. This circle is currently taking from the environment and from society positive inputs, such as clean water, clean air, land. From society, it is right now taking our labor, our skills, our time, our investment, our culture. Cultural appropriation is a big issue. And the output of the fashion industry is nothing negative. It's not generating positive value. It is generating negative outputs because it is giving us 100 billion tons of clothing, which on average we use around 7 times, and then trash. And every time we trash something, it can take up to 200 years for these clothing to actually deteriorate and degrade in the environment, depending on the fiber they use. It is giving us wealth, but this is absolutely not equally distributed. We have a very small percentage of people in the fashion industry which hold the majority and the bulk of this wealth. Some of the richest people in the world are at the top of big fashion conglomerates, whereas we have millions and millions of garment workers who live in conditions of modern day slavery. It is giving us pollution, it is giving us health issues, it is giving us complete contamination of our natural resources. So you understand how in physics a system like this would have ceased to exist in a matter of seconds, because it is absolutely not sustainable. What is keeping the system alive is its capability to produce financial wealth, which is justified, and the only reason why it's justified is because it is not considering the real cost of the product into the equation. It is not considering the natural, it is not considering the social, and it is not considering human capital. We're only focusing on the financial capital. So that is the biggest, secret around the fashion industry and why such a non-sustainable industry is kept alive. Then there's a problem with transparency and traceability, I believe, and again, to the point of Theodor. Right now we have a lot of companies who are pretty much creating their own version of reality around the word sustainability, thanks to the unlimited financial resources that they have. I'll translate. They have so much money to spend on marketing ads to claim and create their own standards of what sustainability means, that people tend to believe it because there's really no guidance as to what sustainable fashion means. And that's a huge problem, because when you have such information asymmetry in the market, where we have a small percentage of people that hold the truth and really understand what organic cotton or recycled polyester or post-consumption recycled polyester mean, and the vast majority of the people that have to trust, this is a big word, trust what these brands are saying, you create market inefficiencies similar to the lemma theory of Akerlof, where the lower quality products tend to obviously kill higher quality products at the expense of more sustainable collections in this case. The issue is so vast that, in my opinion, in order to rewire the economy around sustainability and sustainable fashion, it is absolutely not enough to focus on the product side. A lot of companies, we're all very focused on ingredient branding and kind of like transforming the way the product is engineered. That's a huge aspect, because obviously the product is the output, and that's what we purchase and that's what we invest for. But the real revolution needs to happen at a broader scale, rewiring the way the product is produced, therefore transitioning from a very individualistic linear business model to a fully circular business model that includes and connects all of the dots in every single stage of the life cycle in the product making, from fiber and thread creation all the way to the customer, who has to have the tools and the infrastructure that enables them, because that's the problem here. We don't have any tools that enables the customer to directly and concretely activate a circular business model, meaning returning the use closed and making sure that these are recycled in a closed loop system. Right now, we only have 1% of the entire outputs of clothing of the fashion industry in a single year that are recycled back into the system. The rest is thrown in landfill. That's a huge issue. So circularity is the big one, the biggest driver towards the rewiring of the fashion industry. Then we have transparency and traceability. We need to make sure that people are enabled to access the truth about who makes the clothing, where, and how. And then the biggest and third one for me is making sure that we transform the product into a true service, because at the end of the day, for any company that works in the fashion industry today, we have to come to the humble conclusion that we are producing non-essential items, clothing, using essential resources. Again, I'll translate. We are using the same ingredients that are needed to create a loaf of bread, which is something that people need to survive, to create t-shirts and jeans that, honestly, I mean, I don't see anybody here, but raise your hand if you need another t-shirt and jeans. Like, we have enough. And until we realize that truly we don't need another brand or another company to produce millions and hundreds of millions of clothing every single year, and compromising resources that are needed to feed and make sure that we keep alive 10 billion people in 2050, it will be very, very, very hard to catalyze the kind of systemic change that we need.
Thank you very much, Matteo, Guy, and Theodor, for your keynotes. I just want to seize the opportunity to remind everybody on this event as a participant how to post your question or your comment. You can simply put it in the Q&A chat that you can see the tiny logo on your screen, and post it there, and I will pick it up and pass it to our speakers. So after the keynotes, I think we're ready to get the discussion started. So I have a question for Guy first. Thank you for the keynote and the topics that you touched base there. I know that it's not easy to summarize a lot of contents in 5-6 minutes, but I have a question for you with regard to the latest Risk of Doing Business report produced by WEF, and that you participate and supported preparing that, where the top risks for doing business are mentioned. But what catch my eye is that you wrote there, and in particular in your blog with regard to this report, that with disruption comes opportunity. So can you explore a bit what do you mean in practical terms? You touched base a bit in your keynote that the financial situation is pretty severe, and we need to take measures to let's say to tackle it as soon as possible. But you also had a positive outlook and approach for the future. So can you tell us more about your sentence, with disruption comes opportunity?
Yes, certainly. I mean, I try to be optimistic. But maybe one thing regarding that report, I mean, one of the things that was striking to me of the 10 key risks, nothing related to climate actually made it into that top 10 this year. I guess that's a function of, when you're in a pandemic, other things distract, and we have to be very clear and make sure that that doesn't distract us to avoiding the issues that still need to be tackled. But I guess from my perspective about the opportunity this creates, I think, and maybe there's some hope with even what the ECB are beginning to do, thinking not just about plugging the gaps in terms of the economy. Yes, of course, people need to have a job. Yes, of course, they need unemployment benefit. Yes, of course, you need to keep small businesses going. But beyond that, that's borrowing to keep that productive capacity. We need to think about what does the next year, 5, 10 years hold. And that's why I'm a little bit encouraged by what the ECB have been doing in terms of their recovery fund. So there's been 750 billion being placed to allow growth to come through in a structured manner, not just plugging holes, but thinking about how can we create more dynamic and fairer growth in the years to come. And this money will be deployed in a way that is much more thought out than simply plugging the gaps that we're seeing right now. So that's some example of encouraging evidence that we're seeing coming through, but it goes much beyond this. I think what you've heard from the three of us is that if we're really to tackle the issues of climate change and the disruption that causes, this needs to be ingrained in almost every element of all our businesses, of all the opportunities that present themselves to us. We said that we need economic growth, we need prosperity, we need to lift people out of poverty, but we also need to make sure that we do that in a way that is not damaging the planet. You know, and as Theodor pointed out, this is not about just keeping things the same. We actually need to make reductions in terms of emissions and output. And one of the things that struck me in listening to Matteo about the costs are not included in cheap garments. We've all become used to cheap flights. We're all used to cheap fashion items, but that's not reflecting the externalities, the real cost of this. So we need to think about a way, how do we break the economic from the emissions? And one way I think that we need to think about doing this is about carbon pricing, one of many ways. But if you think about the world, and if you think about what Matteo said about the clothing and fashion industry, globally, only about 15% of emissions are actually priced at all for carbon. And if you look at the price that is being applied to only that 15%, it's about $20 per ton of CO2 equivalents. In other words, if you think about what the World Bank says about needing to price carbon in $80 to $120 per ton of CO2 equivalents, we're nowhere near there. So my point is that we need to acknowledge these things, and we need to focus on making sure that we stimulate growth in a way that is more sustainable in the longer term, and we price these externalities accordingly. Because if we don't price them accordingly, you know, we're never really going to make an economic impact on this. We need to have economic forces working in favor of forcing change.
Thank you very much, Guy. And I have another connected question to the keynote that you just gave us. So you mentioned how to recover better or build back better. And also Theodor touched base on responsible investment and sustainable investing. Being yourself an ambassador at Zurich for responsible investment, can you tell us a bit more what Zurich is doing in this space?
Yeah, I mean, it's important, and I completely agree with both Theodor and Matteo, which means that we need to be outcome focused. We shouldn't be greenwashing. We should be measuring the impact that we have and making sure that it's outcome that is a meaningful element around here. At Zurich, I mean, we take a three-pronged approach. One is that we look at impact investing. One is that we make sure that ESG is embedded in our day-to-day activities, in our portfolios, whether it's our credit portfolios or our equity portfolios. And the third thing we do is we make sure we take every opportunity to try and influence the people that we speak to, the companies that we invest in, and the governments that we encounter. And, you know, when I think back to really 2012 was the first year that we really got actively involved in terms of our first $1 billion commitment to green bonds. That went to $2 billion. I'm glad to see that as of a couple of weeks ago, our exposure, our investments in impact investments have now exceeded $5 billion. Now that's good, but we need to make sure what is the impact that is actually having, and we make sure that that is measured. So it's a combination of these three forces, making sure that the impact has tangible outcomes. It's making sure that ESG is embedded in everything that we do as a normal part of our core business. And it's making sure that we influence the people that can make a difference, whether it's in terms of the subsidies that are still being paid out to carbon energy generators, or whether it's companies that are overlooking water rights or biodiversity issues. We need to try and make a difference.
Thank you very much, Guy. And we have a question from the audience that I wish to pick up because it's very much related to this. So the question is, in the current downturn, highest unemployment rates for decades, how can we balance job creation, which could come, for example, oil and gas, with the opportunity to build back better and more sustainably? Is now really the right time to remove carbon-intensive jobs?
Is that to me, Nicoletta?
Yeah, if you want to pick it up.
I mean, maybe to start off with, I mean, the first thing we need to do is make sure that we remove the subsidies that are still being applied to carbon industries. That is such an easy thing to do. I'm actually optimistic in terms of new technologies, new ways of doing things. I think it does encourage job creation. Everybody's worried about digitization, and every time we've had an industrial revolution, there's always been this issue about jobs. I'm more inclined to see this as beneficial. Over time, it's likely to generate more jobs. We just have to make sure that in terms of the direction that we're going in, we continue to make sure that we're either in a level playing field, or we find incentives, whether they're economic or otherwise, to make sure that the job creation is in areas that actually improves the planet that we're living in.
Thank you very much. And then now we have a question that, let's say, is applicable to all of you as speakers. So the question is the following. What is the role of profits in making the economy more sustainable and equal? Do we have to change how we view, share and distribute profits? Maybe Theodor, you can have a go because you briefly touched base on your keynotes on something like that. So with regard to responsible investment and sustainable finance, would you like to pick it up first?
Sure. And if I may, I'd just like to maybe also pick up where Guy finished and then answer this particular question on share and profits. So on the job side and on the subsidy side, it's very true. We have a lot of in a way, conflicts of interest and tensions in the system that whenever we're trying to argue what's sustainable, you have actors or institutions in our system which are conflicted. We're talking about the transition. So in this transition, we have to transition from brown to green. So that means that some institutions, by the virtue of their holdings or their loyalties or whatever it is, will be exposed to both. And so we need to be aware of these conflicts of interest and really be wise on how we can do this decarbonization fast. I will give you one example. It does happen in investment banking at the moment. So the way we are financing new fossil fuel infrastructure around the world is through new bond issuance and through new syndicated loans when, the size of the projects, the fossil fuel infrastructure is so large that you can't have one individual bank financing it. So you have syndicates of banks coming together to do this. And then on the other side, we have banks financing the new wind farm and other solutions. And so when you think about the question of greenwashing and being able to really substantiate your credentials, if we understand that, and I think this is in particular to financiers around the world, if we are going to do this transition right, you really need to be able to articulate your transition plan and how that financing will flow from green to brown and how you're perhaps managing these conflicts of interest. Now, with respect to the share, how do we think about profits? How do we think about growth? Let me talk about perhaps the opportunity, the green profits. It's an enormous opportunity to be able to rewire your economy. This is where your innovation, you can unleash the innovation of your not only entrepreneurial community, but also your incumbent community who will like to reinvent themselves. And this is where perhaps we have a lot of the upside. So in terms of perhaps producing these returns. Now, with respect to defunding fossil fuels, that's more about the risk management and perhaps not being caught off guard when, as we've seen with coal, a lot of these industries become not only just unfeasible from a climate perspective, but also from an economic perspective. There's a lot to unpack there in terms of whether how we should think about equality and again climate justice. It's also about jobs. In the previous comment that we've spoken about, is this the time? I think the question is also, is this the time to remove carbon intensive jobs? And I Well, I think this is, for a politician, that's very much the weapon to use, against any of these arguments. I think we should say, isn't this the time to repurpose some of these jobs and retrain and find ways for which people can contribute to a meaningful and sustainable economy? And I would say yes. And if that means perhaps having some industries and some types of jobs that we won't do anymore, I think that is absolutely fine. But again, we need to do this in a socially justice way.
Thank you very much, Theodor.
Thank you.
Thank you very much for having answered to two questions at the same time. We have a couple of questions from the audience for Matteo. I will read them out loud and try to merge them together. So one question is, the discussion on fashion could be replicated in other industries as well. And a big problem is that the demand for products, clothes or other is fueled by marketing, social media, and so on. How can we all take steps to change the dialogue from the need to consume to the need to be more aware of the economic, social, environment implications of our decisions? What can individuals do? And another question very similar is, how would you recommend to find out from a personal and individual point of view the sustainability strategy of each of the brands in order to make our own independent decision what we buy and what we purchase?
Thank you. Two very interrelated questions. We can start from the last one because it transitioned into the answering the first one. The fact that there is a vacuum in like a legal vacuum in the general standard and definition of what sustainable fashion means and what organic cotton means, or when companies claim to be a sustainable fashion brand, has led to the rise of many independent auditors, apps and platforms that are doing the job, taking on the task of assessing and really verifying the sustainability claims of a lot of fashion brands. Depending on the parameters, I would suggest to check out the Fashion Revolution's Transparency Index, which is a good indicator for 200 of the biggest brands around the world of how transparent they are, which doesn't mean that they're sustainable from an environmental perspective, responsible from a social perspective. It pretty much tells us, hey, these companies are taking steps to be transparent and honest about how they source their raw materials and where they produce. And that's one indicator. Another good indicator is the application Good on You. They've been rating brands for years now on more parameters, more dimensions that touch on the environmental perspective, the social perspective, so for the welfare of the garment workers, and then a human health perspective, like the impact of specific processes, dyes, or fabrics that certain brands use and source on our health and our skin. The fact that we have these kind of apps and these independent platforms that have risen because governments and have so far, missed on the opportunity to help us understand and define and regulate the market for sustainable fashion, gives brands a huge opportunity to address the first question: how can we help the market transition from a consume approach to a different approach where I'm helping customers navigate the world of uncertainty of this post-truth society where we don't really know what we're buying, what we're drinking, what we're eating, what we're wearing every single day. And the answer lies on how honest, obviously, these brands want to be. Sustainability is not a thing to do, it's a thing to be. If you're trying to do sustainability, I will try to, I'm pretty much going to try to sell you a sustainable t-shirt the same way I've been selling you a non-responsible t-shirt the day before. Therefore, I will be using the same marketing tactics that have been unchanged for the past 40 years, which are based on trying to establish a short-term transactional relationship with you as a customer, versus what I believe companies should do today. Not only because it's the right thing to do, but also because it's the right thing to be, and I believe will legitimize brands in the next 10 to 20 years, because customers will look back at what brands are doing. which is try to establish a more long-term value-based relationship that it's a more impactful dialogue with the customer rather than a short-term transactional relationship. It's a narrative that has value and transcends the product that I'm selling you. I'm trying to help you understand as a customer how you can amplify through my product your, maybe it's a mature responsible identity, or it's a responsible identity that you want to amplify. This is what the Gen Z and the millennials are looking at right now. They're trying to figure out which brands are going to help them amplify an identity which is based on social environmental values through their purchases. And a better narrative like this one will not only, develop trust, to help develop trust with the customer, but would also really help us catalyze the rise of more responsible business models and helping people understand that with their purchases, they're pretty much making an investment. It's no longer purchasing a product because it's cool. And yes, of course, fashion is per se an industry where products and transactions are going to be impulsive per se, and the creativity of the industry needs to be wary of that. But how to use that creativity to make sure that customers are using their money to invest in programs and honest missions that brands are putting up and forward to help address the key and the true needs of humanity, which is climate change, which is water scarcity, which is demographic population increase, which is food scarcity, poverty. How can we help as customers, companies that have the resources to address these issues? That is pretty much on the brand side to establish a more honest and impactful dialogue.
Thank you very much, Matteo, for covering several questions at the same time. We also have other questions in the chat, more or less on the same topic. So how can consumers be more informed, how they can make better informed decisions? So you mentioned a couple of apps and indexes that everybody can, let's say, concretely check right after the session. So thanks for the very practical and tangible tips. There's actually a question that I would like to pick up. I don't know, Guy, if you want to take the lead on that, but the question is the following. As an investor and a shareholder, can Zurich be more vocal and, for example, use shareholding voter rights to influence the behavior of investing companies toward more sustainable and environmental justice? So we've been hearing from Matteo and Theodor, let's say, more tangible and practical examples from different types of industries. So Matteo mentioned the fashion industry and Theodor the investment management and other financial services. So what can we do from an insurance point of view in order to play our role as a global corporation with the possibility to have a lever to have an impact on towards a more social and environmental decisions?
Well, I think that comes back to my 2 points. One is on the influencing side. So it's making sure that we use our brand recognition to influence parties in terms of changing behavior, whether it be regulators, whether it be governments, or whether it be companies. There's also what we can do in terms of our portfolios. And I said, making sure that we don't just pay lip service to ESG, for example, but embedding it in what we do, making sure that our portfolio managers question and challenge companies in terms of some of their policies. And we've got good examples. One I think was around water, where we have pulled back investments and we've then reinvested in companies as well, where we believe they're doing the right thing. And in terms of the specific question about the shareholder voting, absolutely, we need to make sure that we are active and constructive in terms of making sure that portfolios and companies are managed in the correct way. Maybe I want to just link it to a question that you had earlier about profitability. Because profitability, of course, isn't being measured correctly if you misprice the externalities. And again, this comes back to a $2 T-shirt or a $20 flight. These are not real economic prices of that. If you price in the externalities of that, clearly they're much more expensive. And in a way, this comes back to the point is that you can't have disposable fashion. You can't have 1% of fashion being recycled. You can't have me jumping on an EasyJet flight every weekend for $20 flying off somewhere nice. You have to price that correctly. And if you price it correctly, unfortunately, in some ways, the demand will go down. You could say, again, this favors people who are richer in society. But until you have a way of doing that, it's going to be very hard to change behaviors. And that's why I still come back to this notion of pricing these externalities, whether it's a carbon tax or a carbon price. But me adding an extra $1 to my Ryanair or EasyJet flight makes me feel good, but it doesn't do anything in terms of really offsetting or really making a difference. So that's why I do think we have to have a taxonomy developed in terms of understanding what prices are applied to these various externalities, not just carbon or CO2 emissions, but other things, to make sure that we can direct ourselves and change behaviour, because this is something that's going to take all of us a concerted action, and it's going to take time, and frankly there's going to be a cost that comes with that.
Thank you very much, Guy, for covering this question. There's actually a couple of other more with regard to Theodor, thanks for having shared in the chat for some of you, if you're interested, couple of papers, if anybody wants to, let's say, dig deeper on those particular topics. And there's a question, there was a question also with regard, back to you, Theodor. You mentioned the EU taxonomy, and also in your role of, let's say, member of the Sustainable Finance Platform. Can you tell us briefly in a couple of minutes what is that about, and what's happening at European level in order to tackle this?
Sure, it would be my pleasure to do so. So the European Union for the past 2 years has had what is called a technical expert group on sustainable finance, which was really tasked with understanding what are the particularly climate change mitigation economic activities that are sustainable. So in other words, when I talk about economic or activities, I don't talk about sectors. So it's not that one particular sector is sustainable, but the different activities that a company does, you know, are sustainable or not. So in the case of perhaps a conglomerate, you know, we won't be calling them diversified or perhaps even industrials, but we would look very deeply on whether they produce, for example, conventional cars versus electric cars versus renewable energy. And so the EU Technical Expert Group has devised this EU Green Taxonomy, which then is able to identify these sustainable economic activities, particularly in the area of climate change mitigation. And this would allow us to do what Guy alluded to, which is, from a scientific perspective, we will be able, you have a policy standard which says, it gives us a way to analyze how we can shift funds from basically brown to green. Now, for the next 2 years, the platform on sustainable finance is a similar construct where a few other experts have been brought on board, including myself, and a few NGOs to look at other issues other than climate change mitigation. So we'll be looking at biodiversity, at the circular economy, which is also touches on the fashion sector, which Matteo is closely looking at. We would be looking at water issues, and then pollution prevention. So as you see, for the next 2 years, the emphasis would be to expand this climate change view into broader environmental issues and be much more comprehensive. I'd like to perhaps conclude my answer, again, perhaps referring back to what I think is a really good question on also what perhaps insurance and reinsurers do, and particularly with the power of the shareholder. With respect to fossil fuels in particular, because the main source of funding is debt and not equity, the question is, what is really the biggest stick that we have to companies, you know, to incentivize companies around the world? And while indeed having a voice in meeting with the management and voting in the annual general meeting is indeed, you know, a power in itself, I think perhaps the biggest power is actually the bond holding power, which is if you engage with companies and deny debt to all those companies that do not have a credible action plan past 2050, and they do come to bond markets and try to raise funds way beyond 2050. We have oil and gas issuances up to 2060, 2070 with no disclosure of carbon emissions. Then that is a really powerful tool. And if you have a coalition of bond investors around the world, which are very sizable and start denying these new fossil fuel issuances, I think that is extremely powerful.
Thank you very much, Theodor, for having covered that. So we have actually still a lot of questions in the Q&A chat. Apologies for the ones that we didn't manage to cover, but we have 5 minutes left for this session. I encourage if any of you wants to learn more, to have a look at the sources that Theodor shared in the chat. So you have the links over there, or to reach out to our next@zurich.com if you have additional questions, and we will be able to pass them also to the speakers if you want a more, let's say, more detailed or covering some other topics. So let me wrap up briefly and try to summarize all the contents that we covered today. So what I'm very keen of, and some of you actually put in the question chat, what can we do besides being within corporations? What can we do as individuals in order to make more sustainable choices and being more aware and making more informed decisions? So for example, with regard to as consumers, so what do we buy? Clothing or not, many other options as well. Matteo mentioned 2 options. So there's a Fashion Revolution Transparency Index that you can check with regard to the clothes and the apparel that you buy. So you can check over there how the companies are ranking according to that index. But also there's the app Good on You that will give you a bit more transparency on, let's say, on the processes, on human rights, how people is treated in the supply chain and on the production of let's say, apparel and clothing. Guy mentioned that what's important is pricing externalities. So we've seen that there's a lot going on from an economical point of view, but we also have sufficient hope, and we should be positive for the outlook of the months and years to come. So governments put in place enough standards. We also heard from Theodor in particular with regard to the platform for sustainable finance that is also member of, that there's a green taxonomy in place. There's also a lot of initiatives that are, let's say, organized in order to cover this topic. But the key topics that we mentioned today are for sure transparency, traceability from a process and product point of view, and also Matteo touched base on circularity. So what's important is that from the, let's say, from the creation, so from the utilization of the natural resources until the very end step of using the products that are being produced either in the fashion industry or in any other industry, the concept of circularity, and in particular of circular economy, it's very, very important. So Matteo brought his experience from the fashion industry, but I think personally, I don't know what about the speakers, but I personally think that the circular economy principles can be adapted and used also in other industries. The question mark, that was also a question in the chat, how can we apply, and is it possible to apply circular principles, circularity principles for insurance and also in financial services. So I leave you with this question to you, if it's possible to apply this one. Unfortunately, we cannot cover these topics as well into this session. So I thank you very much, our speakers, for being with us today and for having covered a lot of content in this very short hour. And I thank you very much, the participants that have been with us live. And I just want to seize the last minute of this session to share with you the upcoming sessions that we have for the summit in the next days. So give me a second. Here we are. Sorry about that. Sorry for the wait. So as you can see on the screen, yesterday we had our first event, Future of Generations at Zurich, and today we had the second one. Thank you very much again to Guy, Theodor, and Matteo for being our speakers for Future of Economy. This afternoon, we will cover the topic of Future of Earth, and our speakers are Karen McClune from the scientific community, and from the entrepreneurial world, Gustav Stambeck, and our very own David Nash from the Zurich Foundation. Tomorrow, we will have a session on Future of Corporate Social Innovation, where our Gary Shaughnessy, the chair of the Z Zurich Foundation, will speak together with Mariana Carvalho, one of our 2019 Wang Yang World Scholarship recipients, and Joel Agard, our innovation strategist at Zurich. On Thursday, we will have the last two events of this summit. We will have in the morning at 10 a.m. the event on Future of Work, where our own Christine Olter and Nadia Nunes will be our internal speakers, and Simona Scarpaleggia, the CEO of Edge and former CEO of IKEA Switzerland, will be on the panel. We will close the summit on Thursday afternoon with the event on Future of Society. Our very own Siwan Lu, CEO of Zurich Insurance Mobile Solutions, will be on the panel, together with two external speakers, Ronnie Abergel, the CEO of the Human Library Organization, and Bill Kearney, a business school professor, entrepreneur, and former corporate executive. So thank you very much for being on our event today. Thanks once again to Guy, Theodor, and Matteo for being our speakers. And thank you very much for those who participated to our session today. If you have any question, any doubt, or you would like to know more, please write us to next@zurich.com and make sure to register your place for the future sessions. Thank you very much, everybody, and have a good day and good afternoon.
Thanks all. Bye.
Thank you.
Bye.
Bye-bye.
Thanks so much.